Okay, so imagine this. You're sitting there with some money in your checking account, and you know you should probably do something with it. You've heard about investing, you know it's important, but every time you think about it, your stomach does that weird flip thing. So you tell yourself, I'll just keep it in my savings account for now. At least it's safe there. And here's the thing, that feels like the responsible choice, right? You're not gambling your money away, you're not making risky bets, you're just being careful. Except, and I really hate to be the one to tell you this, that safe choice is actually costing you a fortune. We're talking tens of thousands of dollars over your lifetime, just evaporating because you wanted to avoid feeling uncomfortable for like an afternoon. Let me show you exactly what I mean with some real numbers, because this is where it gets painful. Let's say you're 30 years old, and you've got $10,000 sitting in a savings account earning, generously, about 0.5% interest. You leave it there for 30 years because, hey, it's earning something, and it feels safe. By the time you're 60, that 10 grand has grown to about $11,500. Congratulations, you made $1,500 in 3 decades. That's like $50 a year. Now, what if instead, and stay with me here, you had invested that same $10,000 in a basic index fund? Historically, the stock market returns about 10% per year on average. Some years more, some years less, but that's the long-term average. After 30 years with that 10% average return, your $10,000 would have grown to about $174,000. Yeah, you heard that right, $174,000. So the difference between playing it safe and actually investing is about $162,000. That's not a typo, that's the comfort zone tax you're paying for avoiding a little bit of temporary anxiety. And okay, I know what you're thinking, but the stock market is risky. What if I lose money? Valid concern, except here's the thing people don't realize about risk. There are different kinds. There's the risk that feels scary, like watching your investment drop 20% in a bad year, and then there's the risk that feels safe but is actually way more dangerous. That second kind is the guaranteed slow bleed of keeping your money somewhere it can't grow. With investing, you might lose money temporarily, emphasis on temporarily, but with a savings account, you're guaranteed to lose purchasing power to inflation every single year. Inflation averages about 3% per year, which means if your money is only earning 0.5%, you're actually losing 2.5% annually in real terms. So that safe savings account, it's actually eating your wealth, just really, really slowly. It's like choosing to drown slowly in shallow water instead of learning to swim in the deep end. Neither sounds great, but one of them actually gets you somewhere. Now let's talk about what this actually looks like in real life, because the numbers get even worse when you factor in lost opportunities. Most people aren't just avoiding investing a one-time lump sum, they're avoiding it month after month, year after year. Let's say you could be investing just $300 a month. That's like, what, 10 bucks a day? But instead, you're keeping that money in checking or low-interest savings because investing feels too complicated or scary. If you invest $300 a month for 30 years at that same 10% average return, you end up with about $678,000. But if you just keep that $300 a month in savings at 0.5% interest, you end up with about $116,000. The difference there is $562,000, more than $500,000 that just vanished because you didn't want to feel uncomfortable. That's the comfort zone tax, and it's absolutely brutal when you actually do the math. And here's the really frustrating part. The anxiety you're trying to avoid by not investing, it doesn't even go away. It just transforms into a different kind of stress. The stress of realizing at 55 that you're nowhere near ready for retirement. You traded feeling uncomfortable now for feeling terrified later. Not exactly a winning strategy. So what's the actual solution here? Because I'm not just trying to scare you, I'm trying to get you to act. First, you need to accept that investment anxiety is totally normal. Everyone feels it when they're starting out, but that feeling is actually your brain trying to protect you from something unfamiliar, not from something genuinely dangerous. Your caveman brain sees the stock market going up and down and thinks, danger, because it's wired to avoid losses, but it's totally wrong about long-term investing. Second, start stupidly small if you have to, like genuinely embarrassingly small. Invest 20 bucks, 50 bucks, whatever amount makes you feel like, okay, if this totally disappears, I'll survive. The goal isn't to make a fortune off that first investment. The goal is to get over the psychological hurdle of actually doing it. Once you've done it once, the second time is way easier, and the third time is automatic. Third, automate everything so you don't have to make the decision over and over. Just set up automatic transfers to your investment account and forget about it. This is huge because every month you're not investing is another month of compound growth you're giving up forever. You can't get those months back later. That's not how compound interest works. And fourth, this is important, accept that you will feel uncomfortable when the market drops, and that's okay. The difference between successful investors and everyone else isn't that successful investors never feel scared, it's that they don't let that fear make their decisions for them. They feel the fear, acknowledge it, and then invest anyway because they understand the math. Look, nobody's saying you need to become a day trader or start picking individual stocks. That's not what this is about. This is about taking your money and putting it in boring, diversified index funds that just track the overall market. It's the financial equivalent of eating vegetables. Not exciting, but you're going to be really glad you did it in 30 years. The people who end up wealthy aren't the ones who make the smartest trades or time the market perfectly. They're the ones who started early and stayed consistent. They're the ones who decided that a little temporary discomfort was worth avoiding decades of regret. So here's my challenge to you. Calculate your own comfort zone tax. Take whatever amount you could realistically be investing each month, plug it into a compound interest calculator, and see what 30 years of doing nothing actually costs you. I guarantee the number will make you feel way more uncomfortable than actually opening an investment account ever could. Because when you see that you're potentially giving up $500,000 or more just to avoid feeling awkward for an afternoon, the choice becomes pretty obvious. You're not protecting yourself by avoiding investment decisions, you're just choosing slow financial decline over potential growth. And that's a choice you're making every single day that you put this off. The good news? You can change that choice today, right now, before you finish watching this video. You don't need to know everything about investing to start, you just need to know enough to take that first step. So before you make this mistake with your money, think twice, Tony. Stop letting comfort cost you your future, because that temporary anxiety about investing is way cheaper than the permanent regret of never starting. If this video made you do the math, or at least made you a little uncomfortable in the right way, hit that like button and subscribe so you don't miss the next one. I break down money stuff like this every week, and trust me, future you will be glad you stuck around. See you in the next one.